My name's Alison Smith, and I've been part of the insurance industry for over 20 years and have been appointed to the role of Regional Director in Commercial back in 2017. I'm responsible for Aon Commercial segment across the Southeast Australia section. In this session, we have Michael Parent, Helen Fink, and Luke Ford-Kelsey with us. With the hardening cyber insurance landscape and the forecast into 2022 looking increasingly difficult, a key focus for insurers will continue to be on risk selection. To introduce our speakers, so Michael Parent is a client director and Aon Australia's cyber insurance leader. Michael brings with him 20 years of experience in the insurance industry and has spent 3 years in the Global Broking Centre in London, placing some of the most complex placements for our global clients. Helen Fink. Helen is our cyber placement broker with Aon UK. Helen has over 20 years experience in the insurance industry and has spent 7 years in the Aon Global Broking Centre. In addition, we have Luke Ford-Kelsey. Luke is the lead cyber broker for Aon UK's reinsurance solution. Luke has over 15 years experience in cyber insurance and reinsurance, including both broking and underwriting roles. Prior to joining the insurance market, Luke was a lawyer in private practice with experience in both non-contentious IT law and the reinsurance disputes. So going to our questions. Our panellists will discuss how insurers are selecting risks and the underwriting criteria that's being applied. With that, I will pass to our panellists now, starting with Michael, to discuss from both a local and global perspective, what trends are we seeing in the cyber market? Michael.
Thanks, Alison. So needless to say, it's some challenging times out there in the Australian insurance market space when it comes to cyber. We are seeing some pretty significant increases in premiums, coupled by pretty significant reductions in limits of indemnity, more often than not, coupled with increasing retentions. It's probably fair to say at a starting point right now, basically month by month, we are seeing the market change. You could probably break that down to week by week, to be brutally honest. And coupled with that, we are seeing the markets now becoming much more akin to providing a lower limit of indemnity compared to what they were historically. So if it was 10, you can assume 5 is now the more commonly comfortable limit of indemnity that insurers will provide. And indeed, limits are still achievable, but it comes at significant increase in effort and underwriting information in order to procure similar sorts of limits of indemnity as historically have been provided. So what we've seen is some pretty critical changing around the security environment. Insurers are now very focused on certain security controls being put in place to the point where some organizations may find that they can no longer procure the same limits of indemnity, or indeed they find that coverage might be somewhat more punitive than it has been in the past. And that's all driven by a significant shift in ransomware claims. Whilst ransomware was a reasonably small annoyance many years ago, it has truly been weaponized, and we have seen some of the biggest losses both locally and indeed globally driven directly from ransomware events. So until the baseline of security is increased across Australia and indeed more globally, I can see insurers being quite fixated on being quite more focused on seeing that security is applied to organizations before they deploy their capacity. I can probably talk quite a bit more about the Australian environment, but it's probably quite a good chance to hand over to Helen, if you don't mind, Helen.
Hi, Mike. Yes, I agree with you totally. What we are seeing due to the ever increasing of ransomware events, we are basically experiencing exactly what you're seeing in Australia, and maybe more so because London being a market where is accessed worldwide from the global world, and as a result, we are seeing an ever increasing or decrease in availability of capacity and increasing rates, restrictive coverages, and what underwriters are the way they're approaching it is to become more and more punitive. As I said, the main issues are the shrinking in capacity, the restrictive cover, and really considering that we used to be the go-to market for large limits in capacity and wider coverage, that is actually changing quite radically. Most of the markets are increasing premiums by 50 to 100%. In some cases, we've seen even more. The restrictive cover comes with the introduction of the ransomware co-insurance, where markets are applying a 50% co-insurance on all claims arising out of ransomware events. Now, as you alluded to, this is what's causing the hardening market, but of course, this is the cover that clients so desperately need. So by reducing the cover, you actually are putting clients in a very difficult position because they pay more effectively for less cover. We've seen a lot of markets reducing coverage on contingent non-IT business contingent business interruption, where in the past clients have enjoyed this coverage. Once again, sometimes a very important cover, which they're no longer getting. So really a hard market and difficult for clients to get the cover that they so desire.
Thanks, Helen. Luke, wonder what's your thoughts from a reinsurance perspective with noting the insurance position? I think you might be on mute.
Luke, you're on mute.
Sorry. It's not dissimilar. The reinsurance market has grown into this market, so a slight difference there with the insurance market. So we saw more limit being deployed from the reinsurance market this year, but I can't confidently say that will continue next year. We'll have to see. But certainly the reinsurance market is being a lot more careful about how they deploy their capital.
Interesting. Thanks all for those insights. It is really good to see what's occurring in the market, and it seems very, very dynamic, certainly a day-by-day prospect. Michael, in light of the market conditions, access to capital is becoming more challenging. What's some of the learnings that you've had over the last 6 months as the market has rapidly hardened?
Yeah, so probably one of the major learnings from my point of view is that you need to be in the market earlier, but to expect that you will run the wire in getting the program put to rest. It is quite challenging. Insurers need to have the information early, but that's not a guarantee that they'll be able to review it as much as they need to early, because unfortunately, and Helen can cover it off in a bit more detail, but you've got this flood of submissions coming to markets, and you've typically got this contraction of authority, which means you're leading to a bottlenecking of referrals. So getting a submission to the right person to make the decision is getting harder and harder, and the timelines are being stretched out. And I think for me, the major change was the speed at which information requirements came through. So if we were having this conversation last year, we would have been able to get a reasonably complex program put together with not a lot of backward and forwarding. As unfortunately we found out, it changed throughout the first 6 months of the year, and quite painfully and unforgivingly. Insurers were demanding a lot more information, much more than they were seeing before, and I actually think they weren't necessarily prepared for it as well. I honestly think that our underwriter colleagues were being told from their referral points that you need to get this information, you need to find out this additional component here, and scrutinise that a lot more. And I actually think that the maturity around that is getting to the point where it's almost outside of the underwriting skill set and moving much more into the consultative approach, i.e. your traditional insurance underwriter is either now very sophisticated or they are outsourcing some of that to actual security consultants. So the scrutiny of the questioning has become significantly different to what it was, and it's just taken time for everyone to get used to that. The really important message is you need to be in the market early. You need to have a much more developed submission than we've seen before, or you will suffer the consequences of prejudice from insurers. Helen, any additional comments from you?
Absolutely, Michael. This increase in the level of information hit us by absolute surprise at the beginning of this year. from basically a good submission to now an extensive submission. And the only way that we have found going in the last, 9 months of this year, the only way that we are able to mitigate in any way these increases and restrictions is to have a well-prepared submission and go to market really well in time. And even then, as Michael mentioned, we still go into the wire. We are going to the last day of renewal and still in need of capacity because markets are flooded. And also, to be honest, I think it's such a hard market, they can pick and choose. So in some cases, we're just not getting the responses that we should be getting. So the level of questions are much more in depth. They're insisting on application forms such as the ransomware application form, which in the past we never had that requirement. And most markets now are doing non-invasive scanning. It's becoming the norm, and we need to be prepared for that. We need to advise our clients on what the scanning is, that it is non-invasive. Clients, the first time they hear it, they're quite shocked. And but we have to work with underwriters and the clients to get this across, because if they don't get answers to those ransomware questions or to the scanning or responses back on the scans, we lose the capacity. They will walk away from it. And as a result of that, we have to work with underwriters and clients to make this work.
The other thing I'll add to that as well, increasingly we're seeing insurers refusing to go on risk. So it might be a long-term insured of a particular insurer. If they don't get the questions that they need addressed, if they don't meet all subjectivities, they will not go on risk. That's maybe not unheard of within the cyberspace, but it certainly is now far more common than we've ever seen before. And you just need to be really focused on having a quality submission. And I'd also suggest that presentations to the market are now critical. It is a competition out there. You are vying for the insurer's capacity. It is a pageant parade, and if you are not stepping up, you will be you will fall subject to their prejudice.
Oh yeah, Michael, I agree with you 100%. Basically, what underwriters require now is not only quality, but they want quantity too. There's a huge amount of information that they want, and really, it is also. The important thing is to guide the client through this. It's very important because clients are finding it quite daunting.
Thanks so much for that, Michael and Helen. And I think that following on from that, I think one of the things that I think about is around alternative risk financing strategies that organisations are able to adopt. Because if there is times where we're unable to source cover or the limits that they require from the traditional markets, what can we do around alternative risk financing strategies?
Yeah, so from my point of view, I won't cover off on the reinsurance. That's certainly for Luke to cover off, but that's a key critical component of the insurance industry as well as the cyber industry. I think the natural one for myself that's going to get much more attention and focus as time goes by, certainly now, is the use of captives and the increasing use of captives and additional solutions around that captive, such as white rock sort of styled solutions, which is captive for sale, if you will. I think insurance-linked securities will be a continuing thing that we will see grow and develop over time. And whilst it's still very much a similar insurance solution, I think the parametric styled solutions will become a bit more common as well. Potentially alternative solutions such as cyber umbrellas, associating excess of other programs, maybe much more of as a catastrophic loss style solution. The only one that I'll really talk to, because all of those are very interesting, but most of them are in their embryonic stages at this point. I think the one that I probably focus on the most, other than reinsurance, would be the captives. So captives are basically a company established by the insured to act or to take care of the insurance of the company. It is a separate entity to the insured, but it is really there to serve the insured's purposes from an insurance perspective. But for all intents and purposes, it needs to run and operate like an insurance company in its own right. So it needs to fit certain parameters. It needs to fit. It needs to be funded accordingly, and it needs to do insurance deals that make sense. They need to be somewhat comparable to the insurance market. And again, with that sort of a lens in mind, it needs to go through the similar, or it should be going through the similar sorts of issues that the rest of the insurance market are going through. I think captives are probably the thing that will be the most relevant for everyone. Here in Australia, we are seeing the captive utilisation increasing, but it's still maybe somewhat slow. And to be very fair, cyber is the most unknown line of insurance that we currently have. It's also the most dynamically shifting risk. So I personally agree, a captive really needs to tread carefully, but it should be considered as an alternative solution. Helen, what are your thoughts on captives as in general, but also the market?
Yeah, so in the past, and when you're talking cyber, it's quite the recent past, but in the past, there were few clients who utilised their captive for cyber, and generally then it was to increase a retention, to reduce the amount of risk transfer basically in their program. But due to the reduction in the market capacity now, we basically face a situation that we are in some cases unable to secure the required limits on renewals and new business. So, in recent examples, I can give you two of my most recent renewals. We had a current limit of 200 million for a very large global client. We landed up stopping at 175. We just did not have the capacity available to reach the 200. We have another client who currently, or did in the past, buy 450 million. We basically landed up ending on 320 million. So there's a substantial loss of risk transfer capacity available. So as a result of that, clients are weighing up the economic cost of risk transfer, and sometimes it makes no business sense to continue, but in some cases they have a captive to fall back on. And if they do, they are pulling these captives into these placements now, not only at the bottom of the tower, but sometimes right through. So on every layer, there's an element of quota share or co-insurance with the captive, because that is the only way we can get to the limits that are required by the client. So our towers now are a patchwork of risk transfers, self-insurance, and captive participation. So, we are also finding with the restrictive cover, and our aim as brokers is always to ensure that we have full follow form on the entire tower. We don't want restrictive cover in certain parts of the tower. And what a lot of clients are doing, a number of clients now are doing, is they're using the captive to basically have the insurer reinsure the captive, and then the captive picks up the DRC in some of this, or difference in conditions in some of these restrictive coverages. But more and more, those clients who have access to a captive are utilizing them.
That's super interesting, and I've heard reinsurance spoken a lot in those answers. So, Luke, from a reinsurance world perspective, how are you seeing the reinsurance market being structured to address cyber?
Yeah, I think it's really important to talk about that, because a very material amount of the cyber insurance market is ceded to treaty reinsurers. The most dominant style of purchase by the insurance community is quota share. Quota share gives what we call first dollar protection and also sideways protection that responds to both attritional and systemic loss. We're seeing an increasing amount of aggregate excess of loss bought So that's typically in the form of what we call a stop loss, and that's a structure where the attachment point and the limit are expressed as a loss ratio. An aggregate excess of loss protects against volatility, whether that comes from unexpected attrition or a cat event or a number of large single risk losses. Whilst that is increasingly popular, demand is close to outstripping supply, which of course exacerbates what's already a hard market in both the insurance and reinsurance markets. Interestingly, more recently, we're seeing increasing interest from insurers and reinsurers in buying cyber cat protection. So that's a protection that responds to a systemic catastrophic event, but it only responds to that. So it doesn't provide any protection for attritional loss, which is interesting because that means it doesn't provide any protection for the more recent ransomware style impact on the market. But it is a more economic way of buying protection for a cat event by excluding that sort of loss, and it allows insurers and reinsurers to build significant limits of those protections at a slightly more efficient price. And we're seeing that purchase being considered more at the group level because it allows insurers and reinsurers to demonstrate to their stakeholders that they're addressing concerns about the perceived systemic nature of the class, whether those stakeholders are boards or shareholders or their regulators or their rating agencies. And it's increasingly a popular product for reinsurers and retrocessionaires to sell, actually, because what a cat protection does is it forces cyber to be a short tail class of business. And increasingly, by being a short tail class of business, that allows ILS investors to participate in the cyber market. ILS markets need cyber to be short tail because for those investors, it's all about how they release their collateral at the end of the year as soon as possible. So it does open the market up to a much broader capital base, which will ultimately help your clients, the original buyers, because it eases that current supply-demand dynamic.
That's interesting, Luke. And I think you've talked about the structure of the reinsurance market. What strategies are they using to actually deploy the capital that they have?
Yeah, it's interesting because we went from reinsurers, even 5 years ago, being quite passive and being, at the whim of what insurers told them about this class of business, to now being quite the opposite. And I'm listening to Michael and Helen talk, and I can see the influence there from reinsurers. So the very dominant reinsurers are beginning to have a significant influence on the original terms. And on data collection. So in terms of the original terms, you can see their influence on discussions around war exclusions and discussions around critical infrastructure exclusions. So for the reinsurance and retrocession market, those are systemic matters that they need to be addressed. They're also reinsurers rely heavily on third-party modelling, and in order to do that in an efficient and effective manner, they obviously require a lot more data. So hearing you talk about the increasing data demands, I can see the influence of reinsurance there. In terms of their strategy when deploying capital, they're looking at the performance of portfolios relative to one another and relative to history. They're looking at the line size that their clients are typically deploying, and right now they're looking for that number to come down. They're looking at the attachment point, the typical attachment point of their insurer clients, and right now they're looking for that number to be going up. In terms of coverage, they're obviously looking for people to keep that coverage as tight as possible. They're looking for diversification within that coverage. So reinsurers and retrocessionaires will, like insurers, be thinking about their RDS numbers, and the biggest realistic disaster scenario number for any insurer or reinsurer is going to be for cyber is going to be cloud outage. So if you can diversify a portfolio with property damage, for example, that wouldn't contribute to that number, that can be helpful. They'll be looking at the underwriting approach. They'll be looking at innovative uses of technology in terms of assessing risk, but they'll also, again, be looking at the quality of data that their cedents are collecting. Like everyone else, they'll be looking to diversify their own portfolio. So they'll be looking at that on a territorial basis. They'll be looking at the size of original insureds. They'll be looking at the industry sectors that cedents are writing. If a cedent can bring a portfolio that is diversified in all of those ways, then that's great. But of course, not all portfolios will be diversified within themselves. But by having that information, they can make sure it's the reinsurer, the ultimate acceptor of the risk, and make sure it's diversified within their wider book. Yeah, so I think that's the sort of core of their strategy.
Excellent.
I think increasingly the last comment I would say is that we're seeing very much a trend towards reinsurers trying to quantify their downside. And what that means is that they'd like to provide aggregate protection where they have a defined limit, but also on quota shares, which in the past may have been uncapped. They will now be looking to have a loss ratio cap so that they can see that they have they know what their ultimate downside is.
Thanks so much for that, Luke. And I think both from Michael, Helen, and Luke, thank you. The insights that you've provided are incredibly valuable. And I know all of you would be able to speak for days on this topic. It's an incredibly dynamic one and one that's changing rapidly. So as we all agree, the cyber market is looking to continue to harden into 2022. And the things we want to remind our clients is to understand all risk financing options that are open to them, and to be clear about the understanding of the changing insurer requirements. Remembering underwriting criteria and the use of risk selection and capital deployment are all really important factors looking at your cyber program. So thanks everybody for listening in to our AIS cyber session, Navigating the Eye of the Storm. Thanks a lot.